You know, when people look at a massive, beautiful skyscraper, everyone is just completely obsessed with the penthouse.
Oh, absolutely. They look at the gleaming glass, the sheer height, the
Yeah.
views.
Nobody stands on the sidewalk and stares at the concrete foundation. I mean, not until there's an earthquake anyway. Then suddenly the foundation is literally the only thing that matters.
Because when the ground starts shaking, the Italian marble in the lobby is entirely irrelevant.
Yeah, nobody cares about the marble.
Right. The only thing keeping the building standing is that structural engineering hidden underground.
Which is exactly why we're here. Welcome to the Deep Dive. Today, we are looking at the actual engineering beneath the market. We're opening up the exact blueprints that professional analysts use.
Specifically, we're looking at the NISM Series XV Research Analyst Workbook.
Chapter 12, right?
Yes, Chapter 12 on the fundamentals of risk and return. And look, our mission here isn't to give you basic definitions you probably already know.
No, we want to equip you with the mental models professionals use. We're exploring that really delicate, honestly deceptive dance between how much money you think you're making and the unseen forces trying to, rip it away.
It is so incredibly easy to get caught up in the thrill of making money, staring at the penthouse.
Chasing the gains.
Yeah, exactly. But professional finance treats the preservation of capital as the primary directive. Generating a return is completely secondary to making sure you actually survive the inevitable tremors.
Right, which brings us to the most basic question an investor asks. How much did I make?
We all know simple return on investment is a liar.
A very convincing liar, yes.
It's the number amateur traders brag about at parties, right? Like, I made 23% on this trade.
But professional analysts immediately toss simple ROI out the window because it completely ignores the dimension of time.
Right.
I mean, a 23% return in 6 months? That is a massive victory.
Unbelievable.
But a 23% return over 10 years.
Oh, you probably lost purchasing power. Exactly. If you aren't pricing in the time value of money, you're flying blind. This is why the industry standard relies on CGR.
The compounded annual growth rate.
Right. CGR forces you to look at reality by smoothing out the volatility. It assumes your periodic returns are being reinvested, and it calculates the exact steady rate your capital actually grew from day one to the exit.
I always think a simple ROI, like asking someone how a road trip went, and they just say, I drove 500 miles.
Which tells you absolutely nothing about the actual journey.
Exactly. Did you drive 500 miles in one afternoon on the highway, or did you drag a broken-down car 500 miles over 3 weeks on a dirt road?
Right.
KGR finally gives you the average speed. It tells you the actual pace your wealth is moving. But here is where the math gets messy, right?
Very messy.
Because most portfolios aren't just moving cleanly from point A to point B. You're getting dividends injected at random times. You're dollar cost averaging into a position. You're trimming a little off the top.
And that irregular heartbeat of cash flow completely breaks standard CAGR.
Because the time is all jumbled up.
Right. If you deploy $10,000 on January 1st and another $5,000 on November 15th, that second batch of capital hasn't had the time to compound. You cannot measure them the same way.
So what do the analysts do?
This is why they deploy XIRR, the extended internal rate of return.
It's essentially a financial forensic accountant.
That's a great way to put it. It tracks the exact lifespan of every single dollar. XIRR assigns a specific date to every cash inflow and outflow.
Wow.
Yeah, it recalculates the annualized return based on the precise number of days your money was actually exposed to the market, giving you a dollar-weighted reality check on your portfolio's true performance.
Okay, so knowing the true speed of your money is crucial. But speed means absolutely nothing if you don't see the potholes.
No, it just means you hit the pothole faster.
Exactly. And Chapter 12 frames risk as this multi-headed hydra. And the most dangerous heads are the ones that don't look like risks at all until it's too late. Like, I look at something like systematic risk, and it feels inherently unfair. You can build the perfect, heavily diversified portfolio, do all your fundamental research, and a central bank decision across the globe still wipes out your gains.
Well, systematic risk is the water we swim in. It is market-wide and completely undiversifiable.
You just have to live with it.
Yeah. You contrast that with unsystematic risk, which is the company-specific dangers, like a CEO getting caught in a scandal or a supply chain breaking down.
And you neutralize that unsystematic risk through diversification.
Exactly. But systematic risk requires totally different armor.
Okay, let's talk about some of the specific risks from the workbook, because they highlight inflation risk with a genuinely terrifying example that shows just how deceptive markets can be. Let's look at Venezuela in 2018.
Oh, yeah. The hyperinflation there peaked at over 65,000%.
65,000%.
The purchasing power of the currency completely collapsed. But the devastating part wasn't just the currency failing. The Caracas Stock Exchange Index actually rose by over 1,000 times that very same year.
So if you were just looking at your brokerage account balance, you felt like an absolute genius.
Oh, you were a newly minted billionaire on paper.
Right.
But your real return, the return adjusted for what that money could actually buy in the real world, was massively negative.
Because $1 billion buys you a loaf of bread.
Exactly. It's the silent wealth killer. Earning an 8% coupon on a corporate bond feels great, but if regional inflation sits at 9%, your capital is actively bleeding purchasing power every single day you hold that asset.
And then we have interest rate risk, which operates on that classic seesaw mechanic. Like, if a central bank suddenly hikes interest rates, the price of existing bonds plummets.
Because no rational investor is going to buy your old bond yielding 5% when the government is suddenly issuing new, risk-free bonds yielding 7%.
So I have to slash the price of my asset just to make it competitive.
Exactly, which bleeds directly into liquidity risk.
The fundamental truth that an asset is only worth what someone else is willing to hand you cash for right now.
And the text highlights a very specific real-world trap here: sovereign gold bonds maturing in December 2025.
Which sounds like the ultimate safe asset, right?
Yeah.
Backed by gold, issued by the government.
Safe in theory, highly illiquid in practice. The order book for that specific bond showed an 80 rupee gap between the best bid and the best ask price.
80 rupees.
Yes, that spread represents a haircut of roughly 2%. Furthermore, the trading volume was incredibly thin.
So if a major life event happened and you needed to liquidate your position that afternoon,
You were taking an immediate 2% loss just to exit simply because there weren't enough buyers in the room.
wow. Okay, I have to push back on one of the specific risks listed here, though, reinvestment risk.
Okay, let's unpack it.
Because getting paid a cash dividend or a bond coupon is the whole point of income investing. How does receiving cash suddenly become a liability to your portfolio?
I know, it feels entirely counterintuitive until you look at the macro environment.
Okay.
Let's say you lock in a 10-year bond paying a massive 10% interest rate. You've secured a great yield. But 3 years later, the macroeconomic weather changes. Central banks slash rates, and new bonds are only paying 4%.
Right.
When your original bond pays out that 10% cash coupon, you can't just put it under your mattress.
Yeah.
You need that cash to compound.
Oh, I see, but the 10% environment's gone.
Exactly. You are now forced to reinvest that cash at the new, lower 4% rate. So over the decade, your overall compounded return is going to severely lag behind your initial projections because your cash has nowhere good to go.
So the risk is the environment shifting under your feet while you're holding the bag.
Exactly.
Man, with all these forces trying to erode our capital, how do analysts actually model this without just throwing their hands up? Like, we need a way to measure the monster.
Analysts lean heavily on statistical probability. They use standard deviation to measure the historical variability of returns around the average.
Basically, how violently an asset's price swings.
Right. And they pair that with value at risk, or VAR, which assigns a concrete probability to downside scenarios.
Okay, how does that work in practice?
Well, VAR allows an analyst to say, based on historical data, there is a 1% probability that this portfolio will lose more than 12% of its value in a single month.
And then we arrive at beta, the most famous and probably the most widely taught measure of market sensitivity.
Yes.
So a beta of 1 means the stock dances perfectly in step with the broader market. A beta of 1.5 means it swings 50% wider up or down. But the workbook includes a blistering critique of beta from Seth Klarman, the legendary value investor running the Balpos Group.
Oh, he hates it.
He basically calls the entire concept of beta preposterous.
Yeah, Klarman attacks the foundational premise that volatility is synonymous with risk.
Right.
Beta reduces risk to a single number based entirely on past price fluctuations. It operates in a vacuum. It completely ignores the company's balance sheet, its competitive advantage, the macroeconomic landscape.
And most importantly, it ignores valuation.
Yes.
This is the part that completely shatters the academic view of risk for me. Klarman points out that beta ignores price levels. Let's say IBM is trading at $100 a share.
Okay.
The market panics over some macro news, and IBM's price plummets to $50 a share. Beta looks at that massive price swing and screams that IBM is now highly volatile and therefore extremely risky.
But to a value investor, buying the exact same underlying business with the exact same cash flows for $50 instead of $100 is inherently lower risk.
Exactly.
Beta assumes that upside volatility and downside volatility are equally bad. It assumes the market is always correctly pricing the asset, and any deviation is a danger. Value investors rely on the market being wrong.
Wait, if beta is just looking in the rearview mirror at how much a price bounced around yesterday, aren't analysts just driving blindfolded while staring at the speedometer?
Pretty much, yeah.
Like, well, the car is vibrating 15% more than yesterday, but I have no idea if we're heading toward a cliff or an open highway.
That is exactly why the top tier of fundamental analysts do not rely on a single backward-looking metric.
What do they use instead?
They rely on sensitivity analysis. They build robust financial models of the company and relentlessly stress test their assumptions.
Oh, okay.
They ask the hard questions. What happens to this company's free cash flow if raw material costs spike by 15%? What if national interest rates rise by 200 basis points?
They're testing the breaking points.
Exactly. By building a matrix of best case, base case, and worst case scenarios, they map out the actual fragility of the business model, not just the historical bouncing of its stock ticker.
So if the speedometer is broken, how do the heavyweights actually protect their portfolios? If we are throwing out beta, what is the value investor's shield?
The ultimate shield is a concept popularized by Benjamin Graham and mastered by Warren Buffett: the margin of safety.
A margin of safety.
The concept is brutally simple but incredibly difficult to execute. You calculate the intrinsic value of a business based on its future cash flows, and then you refuse to buy it unless the market is offering it at a massive discount to that value.
It's like the engineering principle of building a bridge.
How so?
Well, if you know a bridge needs to support a 10,000-pound truck, you don't engineer the steel to hold exactly 10,000 pounds.
Right.
You engineer it to hold 30,000 pounds. That extra 20,000 pounds of load capacity is your margin of safety. You build it in because you know your original math might be slightly off, or the steel might degrade faster than expected, or some illegal overweight truck might drive across it.
You build a buffer against the unknown.
Exactly.
Because valuation models are attempting to predict the future, which is an inherently flawed exercise. The margin of safety provides the cushion against your own analytical errors, bad management decisions, and severe economic downturns.
And a massive part of that discipline is knowing when to step away from the stock market entirely. Buffett has a strict rule of thumb demanding a premium for putting capital in harm's way.
Yes. You never buy equities just to have exposure to the market. Buffett constantly measures the expected earnings yield of equities against the guaranteed risk-free return of government bonds.
Because equities sit lower in the capital structure, so they are inherently riskier.
Exactly. If the stock market is priced so high that the expected return is lower than what a treasury bond pays, you halt. You deploy your capital into bonds, secure the yield, and wait for the stock market to correct itself.
So if we are demanding extra returns for taking on extra risk, how do we actually prove a strategy is working? Like, how do we prove a fund manager isn't just taking wild, leveraged risks and getting lucky in a bull market?
We strip away the market's rising tide using risk-adjusted returns. The Sharpe ratio is the classic starting point.
Right.
It takes the excess return you earned over the risk-free rate and divides it by the portfolio's standard deviation.
What does that actually tell us in plain English?
It isolates the performance and asks, how much extra profit did this manager generate for every single unit of total volatility they forced you to endure? It's an excellent metric for evaluating highly concentrated portfolios.
But what if I have a massively diversified portfolio where unsystematic risk is already neutralized?
Then you graduate to the Trainer ratio. The math is similar, but instead of dividing by total standard deviation, it divides by beta.
Oh, okay.
It measures the premium you earned strictly against the systematic, unavoidable market risk you took on.
And if we want to measure pure, unadulterated skill?
We look for Jensen's alpha. Alpha is the holy grail for fund managers.
Everyone wants alpha.
They do. It measures the excess return a portfolio generated compared to the exact expected return predicted by the capital asset pricing model, or CAPM.
Right.
If the CAPM dictates that your portfolio, based on its risk profile, should have delivered a 10% return this year, but your active management delivered 13%, you generated a positive alpha of 3%.
Meaning, you didn't just ride the market up. Your actual stock selection added tangible value.
Exactly.
Formulas like alpha and the Trainer ratio are brilliant, but they assume a perfectly rational market. They assume investors are calculating probabilities and optimizing utility. But the second you step off the spreadsheet and onto the trading floor, rationality goes completely out the window.
Completely.
Which brings us to the ultimate boss of investing. The greatest risk to your portfolio isn't inflation, and it isn't a broken supply chain. It's you.
Yes. Human psychology ruins the math. Behavioral finance emerged because traditional economics just couldn't explain why investors consistently self-destruct.
Right.
We are emotional, deeply flawed creatures, and our biology works against us in financial markets.
Chapter 12 highlights some of the most destructive behavioral biases, starting with loss aversion.
This one is fascinating. Neurological studies demonstrate that the psychological pain a human feels from losing $1,000 is roughly twice as intense as the joy they feel from gaining $1,000.
Twice as intense.
Wow. Yeah. That asymmetry creates a paralysis response in investors. You see the red in your portfolio, and the biological pain kicks in.
So instead of rationally cutting the loss and reallocating that capital to a better opportunity, you freeze.
Exactly. You hold on to the losing stock for years, convincing yourself it's only a paper loss, praying it bounces back just so you don't have to actualize the psychological pain of the mistake.
And when we aren't freezing, we are sprinting with the crowd. Herd mentality.
Right.
The biological urge to find safety in numbers. When the market gets volatile and uncertain, humans look at what everyone else is doing. If everyone on television and social media is buying a specific tech stock, our brain assumes they must possess information we lack.
So we buy it too, completely ignoring the valuation.
And that biological mechanism is the exact engine that inflates massive asset bubbles and accelerates the devastating crashes when the herd suddenly changes direction.
It's terrifying.
I'll admit my personal greatest weakness here, anchoring. We latch onto the very first piece of numerical information we see, and we refuse to let it go.
Give me an example.
Well, if I buy a stock at $80 and the underlying business model completely collapses, driving the price down to $30, the rational move is to sell. The fundamental thesis is broken.
Right.
But I anchor to that original $80 price tag. I stubbornly hold the stock, telling myself I'll sell it the minute it gets back to what I paid for it.
Which is pure delusion, because the market does not know or care what you paid for the stock.
Exactly.
The market has zero memory of your entry price. To combat this psychological warfare, Benjamin Graham constructed what is arguably the greatest conceptual tool in finance, the allegory of Mr. Market.
It's brilliant. Imagine you own a private business, and your partner in this venture is a man named Mr. Market. Every single day, without fail, he knocks on your office door and offers to either buy your half of the business or sell you his half.
But your partner has a severe psychological condition. His daily price quotes are dictated by wild, manic, depressive emotional swings. Some days he is overcome with euphoria about the future of the industry, and he offers to buy your share for an absurdly high, unjustifiable premium.
And other days?
Other days he is terrified, depressed, and convinced the world is ending. On those days, he offers to sell you his share of a perfectly good business 4 pennies on the dollar.
It completely shifts your mindset. Instead of feeling sheer terror when the stock market drops 4% in a single afternoon, you look at it like your frantic, unstable business partner having a bad day and offering you a massive discount on premium assets.
And your only objective is to exploit his emotional mispricing. You are under no obligation to trade with him today, tomorrow, or next month. You just wait.
Wait for him to mess up.
Yes. When he is manic, you sell him your overvalued assets. When he is depressed, you buy his undervalued assets. But the cardinal rule is that you must never, ever allow his manic depressive emotions to dictate your own reality.
Right.
As Graham famously dictated, in the short run, the market is a voting machine. But in the long run, it is a weighing machine.
In the short run, it's a popularity contest driven by the herd's adrenaline and fear. But over years and decades, the actual weight, the intrinsic value, and the free cash flows of the business will inevitably pull the price back to reality.
Managing your own psychological operating system is the true, unglamorous secret to long-term wealth. This is exactly why Peter Lynch advised investors to go for a business that any idiot can run, because sooner or later, any idiot is probably going to run it.
So true.
You build in the margin of safety so the asset survives human error. It all circles back to Warren Buffett's 2 definitive rules of investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1.
Bringing this all together, operating at the level of a professional analyst isn't about finding the magic formula that guarantees the highest DRE. It's about recognizing that simple returns are an illusion. It's about mapping out the hidden structural risks, from inflation eroding your purchasing power to liquidity trapping your capital. It's about having the conviction to ignore flawed, backward-looking metrics like beta when they contradict your fundamental research.
Yeah.
You demand a margin of safety.
Yes.
But ultimately, the deepest dive you have to take is into your own mind, recognizing the behavioral biases that are actively trying to sabotage your portfolio.
It demands immense discipline. You have to continuously stress test your own assumptions, and more importantly, maintain the psychological fortitude to stand completely apart from the herd when Mr. Market loses his mind.
But looking at the future of finance, it leaves you with a really profound question to ponder. We just broke down how human behavioral biases, our loss aversion, our herd panic, create the massive inefficiencies that smart value investors rely on to generate alpha.
Right.
But the ecosystem is changing rapidly. Global markets are becoming overwhelmingly dominated by emotionless algorithms, high-frequency trading networks, and sophisticated AI bots.
The players in the game are no longer purely human, which shifts the fundamental mechanics of market pricing.
Right. So as these machines take over the daily trading volume, will the manic-depressive Mr. Market eventually be cured of his human flaws? Will algorithms make the market perfectly efficient, effectively killing the margin of safety because assets will never be mispriced again?
That's the billion-dollar question.
Or will these ultra-fast, pattern-recognizing AI machines simply learn to trigger and exploit our inherent human biases even faster? Could they manufacture phantom panics and euphoric bubbles with such speed that having a rock-solid fundamental foundation, that concrete margin of safety, becomes more critical for survival than it has ever been in human history?
When the next earthquake hits and the algorithms start dumping assets, you really want to know exactly what your foundation is made of.
Keep your eyes on the concrete, not just the penthouse. Until next time, keep digging deeper.